Well, now we'll assume you've got eligible projects, and we'll talk about what are the costs and what are the credits. All right, so qualified expenditures include any Canadian wages, materials, contractors, overheads, and up until the end of 2013, capital equipment. Okay? So I've left the capital equipment in now because you still might have claims where that's an issue. We'll discuss it, but after 2013, there's no more claims for capital.
So they removed that in 2013?
They removed it in 2012, effective after 2013, I believe, yes.
There's no provincial, any provincial governments that will give you any type of credit for capital?
The question was, are there any other provincial incentives for capital? Not in the SR&ED side, but there are other grants and stuff. We'll have someone come in a little later who might give us a heads up on grants for manufacturing and stuff like this, one of our partners. But basically, there's a basic federal tax credit that was 20%. It's now gone down to 15% after 2013. So as we said, all those very large claimants who make up 2/3 of the total dollars handed out each year, they got 25% of their credits just cut. The stroke of Parliament. The littler guys are the guys who are getting their credits cut not by their credit rate, but by denying a lot more of those smaller claims than were ever denied before. Okay? So that basic federal credit is for really any kind of taxpayer, any corporation, any general partners of a partnership, individuals, and even certain trusts can claim that. Okay? If you're a qualified Canadian-controlled CCPC, Canadian Controlled Private Corporation, you get a level of enhanced credits, usually both at the provincial and at the federal level. Okay? These credits are 35% instead of the 20 to 15% at the federal level on the first $3 million that you spend annually. If you spend more than $3 million, then you go down to the 15% credit level of the large claimants. That $3 million threshold is also phased out or reduced if your income goes over $500,000, or if your assets on your balance sheet, your equity more or less goes over, the assets on your balance sheet, taxable capital, goes over $10 million. Okay? So there's a $3 million limit that's shared amongst all corporations under common control. So on your tax return, you have something like Schedule 23 or Schedule 49. It says, here's all the companies under common control, and it's the incomes and taxable capital, the retained earnings, not the assets, of those companies. As they go over those thresholds, you have a phase-out mechanism happening. Okay? So I'll show you this chart. So basically the way it works after 2009 is if you have income up to $500,000 in the prior taxation year, you get the full $3 million. For every dollar over $500,000, you lose $10 off that limit. So by the time you hit $800,000, you're back down to a 15% credit, not the 35% credit. All right? So this has important issues. If you're a CPA or an accountant and you're advising your client at year end, if they should bonus out, because you can bonus out extra cash, usually if you go over $500,000. Okay? And there's different, should I salary, should I do dividend? There's different assumptions that we might make. So again, if you're doing SR&ED credits, this becomes really important that, particularly if I'm hitting the $800,000 level, I may want to bonus some of that money out to keep my income down so that I qualify for the enhanced credits. And that's where your accountant really wants to ask you ahead of time what your income's going to be. We'll talk about the rules on wages, but the way it works out is that anyone who owns 10% or more of any class of stock of the company, or anyone related to them by blood, marriage, or adoption, doesn't get to include bonuses in their qualified wages. Okay? So all the bonus that you bonus out at the end of the year to get your income down doesn't qualify for R&D credits. But if you salary that to yourself and end up with the same income, you pay the same personal tax whether you bonus it or pay it as salary. It doesn't make any difference to you. But in one, the company's going to get the 35%, the other that's going to get nothing, right? So again, this bonus down scenario should keep this in mind. If you've got $500,000 of expenditures, I don't want your income going over $750,000. Right? I don't have to reduce you to $500,000 necessarily, but I want to make sure that I protect that limit. Okay. The other one, and this is less common, is as your equity goes over 10 million, there's a straight line phase out between 10 million and 50 million. Right? Now, Ontario uses 25 to 50 million because they want to be different. And Quebec used to be 25 to 50 million. As soon as Ontario went, they said, well, we got to be better than Ontario. So Quebec says a small company is phased out between 50 and 75 million. They consider you small until you hit 50 million of equity. Again, each province can more or less do what it wants. But the blue line here is the phase out on capital. So I'd say as your equity starts hitting the $10 million level, which is usually very large companies, or your assets go over 10 million, start looking at that calculation. These credit rates make several assumptions. So this is for a qualified Canadian-controlled private corporation, a qualified CCPC. We're going to talk about what that means. So what we'll see is that, we'll just look at Ontario for now, we've made certain assumptions here about the breakdown of these things. For instance, Quebec actually gives, up until recently, almost a 40% credit for small companies on wages. But in our assumptions, we've only assumed a portion of this is wages. They don't pay anything for materials. So if I want to make Ontario look better than Quebec, I just make an assumption where there's a lot of materials, and Ontario will look better. If I want Quebec to look better, I'll make an assumption where there's a lot of wages, and Quebec's going to be a better scenario. So again, like I said, these are assumptions. But what happens here in Ontario is there's two credits. One's fully refundable, the Ontario Innovation Tax Credit. So you spend $100, and Ontario gives you 10 of that back as cash, as a refundable credit, or cash to the extent you don't owe taxes. If you owe taxes, you just don't pay the tax. If you don't owe any tax, you get a refund with interest for that money. A non-refundable credit means if you don't owe any tax, you can still earn the credit, but you can't use it until you owe tax. You can carry it back against taxes you paid in the last 3 years, and you can carry it forward 20 years if you ever owe tax. But if you're not profitable, that's not worth anything to you. Okay? Just like the big companies. Or non-refundable credits, if they're in a loss position, they usually don't bother claiming. It's not worth anything to them, unless they expect to be very profitable in the near future. Okay? So what happens here is we can choose to claim the 4.5% credit or not. We can renounce it if we want. Okay? So let's assume that we claim both credits in the year. We spend $100, so we get $14.50 back from the provincial government, and then we get a 35% credit on the remainder. You said, hey, Dave, you said it was 35%. But what it is the federal government says, well, it's 35% of your net expenditures after government assistance. And we know Ontario already kicked in 14.5, so we're going to give you 35% of the $85.50 net left after that government assistance, or roughly 30%, right? So we're looking at roughly 44.5 cents on the dollar back, assuming that we claim the 4.5% ITC. Now, if we say, well, you know what, and this is the question I usually ask my client, would you rather have $1 today or $3 sometime in the future? Right? Because that's really what the difference is. Okay? If I renounce this credit now, 4.5%, then I'd be more like Alberta. Okay? So I'd only have this 10%, which means I'm actually getting 31.5% back. Right? Cash, $31.50 instead of $30. I'm getting that extra $1.50 back by renouncing $4.50. So for every $45, I get an extra $15 cash back. Would I rather have $45 sometime in the future, or would I rather have $15 today, cash? I don't make that call. I explain it to the client. Ask them, what would you rather do? Sometimes the client says, oh, you know what? I got a big contract coming in. Claim the credits. Others are saying, you know what? I got so much loss carry forwards. It'll be 10 years before I ever see it. I'd rather, and I owe payroll. I'd rather have the dollar today than $3 10 years from now. It's not my call. I just want to inform the client on how they should, what decision to make, and that they're comfortable with it. Yes, Harvey?
My comment was that most of the companies I deal with are pretty well break even, so it always pays to take the extra 4.5% because the ITCs are going to be taxable in the following year, or the Ontario Innovation Credit is effectively taxable in the current year.
Yeah, so the comment was that in most cases the client will claim it, even if they're borderline. But each client's unique. There's no right or wrong. I'd say the more your losses are, or the more shelter you have, the less likely you are. And each client's going to be unique. And again, I don't make that call at all. I ask the client, here's your options. I'm Monty Hall. Pick door number 1 or door number 2. It doesn't matter to me. I win either way. Okay. Same thing happening here now at the other companies. So the rate up until the end of 2014 is 20%, and then it goes to 15% as we said. This is still using the 20% numbers. In Ontario, public companies or large companies could still qualify for the 10% Ontario Innovation Tax Credit as long as they meet the phase-out criteria. And we're going to talk about that phase-out, the $3 million. As you go over the $500,000 expenditures or the $10 million of assets, you phase the Ontario credits out much in the same way as you phase the federal credits out. Okay? So the credits themselves, there used to be limits on how much you can apply, things called minimum tax. They got rid of all that. If you've got credits and you owe taxes, income taxes, you can apply it against it. Okay? If you don't use the credits, you can carry them back 3 years, and you can carry them forward up to 20 years for credits. It really depends on when they were incurred, because the rules change. So credits up to the end of 2005 only have a 10-year carry forward. That's really important to note, because now we're in 2015, they're starting to expire now. So you may want to do other kinds of measures that we can talk about to generate income or use up those credits to the extent possible. Okay. Qualified expenditures. So we'll talk a little bit about shared use equipment and the proxy amount in different sections. And what's not in. So we'll talk about prescribed expenditures, things that are not eligible for credits, payments to non-licensed persons, and that someone has to be a taxable supplier. A taxable supplier means either a Canadian employee who gets a T4 slip, or usually a Canadian contractor who's invoicing you with an HST number. So notice that the T661 form for R&D, asks for each contractor what's their business number. Okay? And if they're over 30,000, they're going to really be looking for it, unless they're exempt or zero rated or some kind of medical supply that might be exempt from HST. Okay? So these are the different budget effects that happen at the end of 2012 and phase in over a period of time, and we've kind of reflected those in the slides. So after 2014, the federal ITC rate for large companies went from 20 to 15%. As we said, that's huge because they represent 2/3 of the total credits handed out each year, even though there's only 4,000 of them. Subcontractor cost. So if I pay a subcontractor $100, I used to be able to claim the whole 100. Now they deem 20% of that to be ineligible stuff, so I can only claim $80 of every $100 that I pay to a contractor. Okay? The rate to calculate something called proxy overhead, we'll talk about that. So I can either calculate what my actual overhead expenses are, which is a fun calculation, we'll talk about in section N, or I can say I don't want to bother doing that. I'll just take 55% of my salary base, my R&D wage base, and that's deemed to be my overheads. And I just get credits on that. I don't use it for my expenses. I get credits on that amount, and I don't have to track my overheads. Okay? So we'll talk about that. And after 2014, there's no credits for capital.